Hello and welcome to the big picture. The Chinese stock markets is once again in a turmoil. And along with it, its government's decision to devalue the yuan, second time in less than 6 months, has raised concerns all over. The impact of the stock market tumbling in Shanghai has been felt all over the world, from America to India, where we saw some steep fall in the Sensex yesterday. The devaluation of the yuan is bound to affect the exports of several major countries also. Why is the Chinese economy suddenly in a tailspin? How much of what's happening is deliberate? What will be the impact of this crisis in China on the Indian economy in particular and global economy in general? We will discuss all this today with Mohan Guruswamy, Senior Economist, Professor Arun Kumar, Professor at the Center for Economic Studies and Planning, JNU, Dhirendra Kumar, Head of Value Research, and on the phone line from Beijing, China, is Atul Aneja, Associate Editor of The Hindu. Welcome to all of you. Atul, how is this whole thing being seen in China? You know, if you see what is the kind of reaction which is coming from across the world to what has happened in Shanghai yesterday and the devaluation of the yuan, you know, it's not a very welcome thing. There are a lot of speculations. What is it that the Chinese are saying about this?
Well, the Chinese today made a correction. They strengthened the fix of the renminbi or the yuan with the US dollar, and that had immediately sent a signal that the Chinese economy was not decelerating as was the signal given on Thursday, because the fix was lower and softer on Thursday. So, you know, that itself has lifted trading today, which has entered the positive trajectory. That's the immediate response. The Chinese seem to be looking at this moment, they don't see a long-term problem, but they are looking at fixing some of the interim steps which they have taken, such as the circuit breakers which had been introduced, which halted trading yesterday because the blue chip CSI 300 index dropped by 7%. So the circuit breaker got activated and trading got halted. So now the Chinese are reviewing this and saying, and they've already suspended the circuit breaker. And the media here, the state media, is pointing out that we need to refine this and fresh research is required. So the point here is that the problem of the stock exchange, yes, it has to be addressed. And which will be addressed. But as far as the long term goes, I don't see any sense of panic which is coming from the government organizations or from the financial media which is active in China.
Okay. Dhirendra Kumar, how serious is it according to you as far as the stock markets are concerned?
No, it is quite serious in a sense that the whole, the global investor community is quite connected. Something significant happens in a large geography, in a large economy, so money is bound to move around. Money is bound to, find different places. So in that sense, a reallocation happens and it has a bearing. But I think, looking at it from an, Indian investor's perspective, I think there is less to worry. We have less connection there. In India, we have, our trade gap with China will increase with this devaluation. That apart, the commodity cycle on a decline, that has its own impact. But I think, what has been reasonably counterbalanced is the domestic investors putting money in our markets. We have been fairly de-risked from, just FII flows in the last 1.5 years. Relatively, we are much better off compared to most other emerging economies. We are a preferred place compared to. So I think we will be a bright spot, relatively speaking. But there are some serious challenges. Of course, this government has done a reasonable job. We are seeing, government-induced, spending. And that apart, a lot of sectors we have reason to be very hopeful of, and some sectors we are seeing, railways, power, a lot of things happening on the ground. But at the same time, nearly 40% of our economy is commodity based, and commodity cycle or the decline in prices of commodity is good in general, or the resetting of or rebasing of this is one aspect. But these companies are going to suffer. These companies will actually face, when you see Tata Steel, I don't think it is an isolated case.
Right.
So we will also be suffering on account, we will benefit on account of this commodity prices decline. At the same time, we will suffer, many of our companies will suffer on account of that. And till that resetting happens, till the rebase actually sets in, we will not have earnings momentum back in our companies to drive up our market. So we are not poorly placed, and a lot of positive things happening, but we are not poised for a big takeoff.
Okay.
Maybe we may not be, the worst may not be, the worst may be behind us now.
The worst may be behind us. That's interesting. Mohan, would you agree with that? Because there is a lot of speculation about the kind of impact it will have on India.
I think Ajay then is still some way off, But, I think there are some fundamental issues I have with the previous speaker. One is that, one is GDP growth.
Yes.
Is not what it is supposed to be.
I'm talking about the impact, what has happened in China, the devaluation of the yuan and things like that.
Of course, there's been an impact on India.
Yes.
Our nominal GDP was supposed to go up 11.5%. We only did 5.2. That means we're off the mark by 6.3%. The reason why we're showing 7.4 real GDP growth is because we have a deflation of 2.2. So, you can keep fudging these things for a while and not see the reality. The reality is that we've slowed down. Exports have slowed down, imports have slowed down. And there is none of this except for the road sector. There's no major push being visible on the ground, on the power sector, railways. There's only talk, the plans. Nothing has happened as yet. And as far as
the impact of what's happened in China.
The impact of China, this is like this butterfly in Gleek's chaos theory, a butterfly flutters its wing in Beijing and it leads to cascades of storms all over the world. So we're seeing something like that, We don't know where exactly. Did it start because oil prices collapsed and the export markets collapsed? There are so many factors playing into this. Also, the flight of capital from China, because, they loosened up capital flows, money started flowing out. And there's a major issue of confidence in China on their own, on their society, the future society. So people are moving money out. All the important people in China have got assets and properties abroad. So, all these things factors are all adding up. And then, the effect on us is that if the world slows down, our export markets have also
exactly,
gone.
and especially China. Professor Arun Kumar, how do you look at this?
We have to look at the macroeconomic situation rather than the micro situation. Right. Macroeconomically, we haven't recovered from the 2008 crisis. And that's why you have periodically...
There's some economists, some writers are saying that what is happening in China is somewhat akin to what's in a 2008 crisis. Would you agree with that?
No, not quite.
Is this crisis of that dimension?
Not that dimension. Of course, Soros has said that and so on. But it's not really of that dimension. But the point is that the world economy has not recovered. That's why Eurozone is slowed down. Last year, Greece had a huge crisis because of which Eurozone had a problem. And therefore, the big export market for India and China was Eurozone. That declined. That's why both our exports have been declining. Commodity prices have come down, which means the world economy is slowing down. So commodity prices going down may be good at a certain point, but it's a signal that the world economy is slowing down and everybody else will slow down. Secondly, what has happened is that finance dominates over the real sense. That's why people say Wall Street dominates over the Main Street. And the world of finance is very unstable and there's a large amount of speculation there. Now, the Chinese economy had a model of growth which was based on growth at any cost. And how did they do growth at any cost? By pushing up exports and by also pushing investment. So their investment rate is very high, almost of the order of 50% of the GDP. Now, the two together meant that consumption did not matter. But as the world economy slowed down, investments did not grow at the same rate, exports did not grow at the same rate, and that's why the Chinese economy faced a crisis. And that is the crisis we are saying. Now, from 2009, the Chinese tried to increase their consumption by increasing wages. But that then hits exports. So you have to, unless you increase productivity in your economy, your exports will not grow because your wages are rising. Secondly, there was a huge stock market boom. In 2014, the price in the stock market rose by 53%. Now, that meant there's a bubble. And therefore, the consumption was based on wealth effect. Now, when the markets come down, that wealth effect disappears. So consumption slows down. So that's why last year you saw consumption was slowing down, investment rate was slowing down, industrial rate of growth was slowing down, and the entire Chinese economy slowed down. And people say it may not even be 7% what is claimed, but it may be more like 4.5%.
Right.
So if the Chinese economy is slowed down, therefore there are these real effects, and that's why the world economy is reacting. The world economy is so interconnected that if China, which is now a very significant player, unlike in 2008, when its share of GDP, of the world GDP was small, Now it's comparable to the US GDP because it's almost $10.5 trillion, whereas the American economy is roughly about $15 trillion. So it's comparable. So if China slows down, it has a global impact. And that's why you see that the BRICS, apart from India, everybody else is slowing down or is in recession. Eurozone is slowed down, Japan is slowed down, only the US is doing slightly better. But on the whole, demand is a problem. And inequalities have risen dramatically. And inequality rising means consumption slows down. So again, consumption has slowed down globally as well as in China. And therefore, these factors together are playing themselves out. And these are all long-term factors. That's why Chinese economy has been in a crisis for more than 1 year, with the yuan going down, with the stock markets going down several times. The Chinese government has tried to intervene, tried to lower the value of the yuan so the exports will pick up. But none of this is working because the global macroeconomic situation and the Chinese macroeconomic situation is not right.
Okay, Mr. Dua. No, Atul Aneja, who is with us on the phone line from Beijing, he is saying that there is not much concern in China as far as to what has happened. Why do you think so? But whereas across the world people are expressing serious concern, Chinese doesn't seem to be. Is that there is also some people feel that this whole thing is a deliberate act on the part of the Chinese government?
It may be partly true, for the simple reason that the Chinese, if you would recall, were last year granted special drawing rights by the IMF on the condition that they would let their currency yuan float. Let it be determined by market forces, not by adjustments which the Bank of China makes, People's Bank of PBOC makes. So to that extent, I think the reaction on the part of the bureaucracy or of the authorities has been minimal. Yesterday, they devalued it by 0.5%.
Right.
Earlier, in August 2015, when the crisis that started, they'd done it by a little over 2%.
Right.
But
even then it was expected that they're going to make another devaluation.
No, but
there may be another further also.
Very right. But what has happened since then, if you see, in two lots, 2% once, 0.5% now, but they did let their yuan float, and actually the currency is down already by about 5.5%.
Right.
And the
lowest since
7 years, and lowest particularly the onshore yuan. There the rates are too different.
Okay.
Onshore yuan and the offshore yuan. The gap between the two has widened. Probably they are deliberately letting it widen, because once the widening is significant, then it calls for executive action by their authorities, which would mean now we have to float it. We can't have two currencies at two different rates floating around. So I think the reaction there of the authorities is muted because of that SDR and the IMF obligation, etc. But certainly they are concerned. I am not sure why should they be not concerned by what they are happening. And there are already apprehensions, Girish, that this could become 10%. What is 6% now? Within a year, it could be as large depreciation as by 10%. Now, that is one. But to my mind, we should not, as the world, apart from India being a little better prepared, etc., what the previous speakers were saying, because the three effects I see of what's happening in China, and if it continues, one, we will see the global economy slowing down. Already the World Bank yesterday has said from 3.8%, it could be 3.3%, and that too, they have not built, they had only seen one reduction and not yesterday's reduction. Second, I see emerging markets entering into a currency war.
That is an important thing.
Each one of them has to worry about its own exports, and exports in turn with the domestic production and other things. Third, and to me, it is probably currency war by itself is not a desirable thing, but if it leads to real effective exchange rates being readjusted, it may be desirable. There is already a point of view that in India, our rupee is overvalued, and that there is need for correction.
Right.
So some amount of Reserve Bank of India action to gradually, to make the process gradual, that not at once reduction takes place because of the Chinese, is called for. But we may well see that the Reserve Bank of India now does not play an active role in holding up the Indian rupee vis-a-vis the dollar and the other major currencies.
You wanted to intervene there. This competitive
Currency war.
devaluation which can happen, and Niti Aayog Vice Chairman has hinted that maybe India also can go in for it.
Yeah. This is the real worry. Financial markets are not only interconnected, but they are highly unstable because they're based on expectations. Now, if the expectation is that the rupee will devalue because the yuan has devalued, other currencies have already declined vis-a-vis the dollar, okay? So in that case, what may happen is there may be a precipitous fall rather than an organized fall, which China may be able to manage, but India has shown earlier that the rupee slid very rapidly because the Indian governments, the problem we have is that our debt is far greater than our reserves.
Right.
Our reserves are of the order of $350 billion, but our debt is about $100 billion more at about $450 billion. And the short-term debt is about $170 billion. So if that begins to flow out, if the FII, FDI, etc., and the signal for that could be that the Americans are raising the interest rate,
right,
whereas there's pressure in India to lower the interest rate. And if you add devaluation to that, the risk is much higher, and therefore there may be an outflow. If that happens, then there'll be a problem, and that kind of problem can happen in other economies also, the emerging markets.
Right.
So globally, it will have an impact.
Yes, Mohan.
I think we have another problem also. $120 billion of our reserves is NRI deposit, PIO deposits. And that money can fly out.
Can just fly anytime.
So, it's really hot money. And if US interest rates are going up, and if the dollar is devaluing, then the threat is always there. And so you have to protect against that. So that's not really a reserve in that real sense. But I think the economy is slowing down. Everybody is slowing down. You can't expect to, but you probably can take consolation in the fact that you'll probably be less hit. But that's like saying that when there's a time of economic distress, it's the rich fellows who get hit most. The guy at the bottom, he tightens his belt a little bit and he's okay. So I think we're in that position. We can't take satisfaction that we were strong enough to weather it. Problem is that we are weathering it because we are weak for it. Yeah.
So, but I'd like to add that the problem that would come up for India's growth would be that we have dependent now on the public sector investment. And that depends on the fiscal deficit. If the fiscal deficit begins to rise and that is cut, there's a problem because the private sector is not investing enough, given that they have spare capacity. Foreign investment, if it goes out rather than come in, then investment rate in the economy, which has already dropped by 10% between 2008 now, when it was 38% to 28% now, that is not going to pick up. If that doesn't pick up, the rate of growth in India will fall.
Private sector profitability is also falling.
I have to go to yes.
Last 18 months or so, ever since this new government came, the emphasis has been on, much more emphasis has been on the external sector.
Right.
We are going to be hit there very badly. And I use the word very badly for the simple reason, one, the Chinese exports become cheaper.
Exactly.
And they are going to be our competitors almost, because there is a similar, textiles, the leather and certain accessories, apparel, etc.
So we are in competition with China.
With China there, and with their ability to kind of enter new markets, and lower the prices.
Lower prices.
Yeah, it is there. Second, our money coming into India, if the rupee is allowed to devalue much faster, or it's not a gradual reduction, then you would see people holding back making investment in India. Whether
so either way, there is a problem. Okay, Atul, there is also a feeling that some observers, some analysts feel that Chinese government thinks that they have been too much dependent on manufacturing. They have to shift to some of it to the services. Some of that, what is happening now, the devaluation and various things which are happening there, is part of that design of the government there. Is that how you also feel?
Look, Girish, there are two things. One is the tactical. We are talking about what happened yesterday at the stock market.
Yes.
Their response is tactical. But, the Chinese are really concerned about the transitioning of their economy from what you mentioned, from the export-led manufacturing, and with the West as the markets for that. And that no longer is a sustainable model for what other speakers have already enumerated, rising wages, etc. So that's not working. So the Chinese at this time are in a major transition. They're very serious about making sure that this transition to what they call the new normal economy, growth rates not spectacular, what we found for the last 30 years, but something like 6.5 to 7%, But more importantly, what they are looking at is that after the 2008 meltdown in the West, it's not that the West is no longer going to be a market of that size as it existed earlier. So they have to create new markets, and they are doing that by what is called by creating new growth engines. Whatever surplus capacity which they have, manufacturing in terms of steel, the expertise in railways, infrastructure development, glass, because construction was a very big deal here, and a lot of bad loans were given on that. So these are the things which they want to offload into new areas, and that is where their Belt and Road Initiative comes, which is there and they are looking at the Eurasian side, that if you build infrastructure through connectivity, that is going to absorb a lot of your surplus capacity.
Right.
And that's why they are interested in moving in the direction of Eurasia rather than towards the West. And even in terms of finances, now they are part, and I think India is a partner with China on that, of helping to create a new financial architecture through the AIIB and through the BRICS Bank, etc. So, the Chinese are thinking long term, they're thinking of creating an entirely new infrastructure with a focus on Eurasia rather than banking on the West.
Okay.
It's a major shift in the strategic path, the strategic thinking of China, and what is happening in between is tactical, I think.
Okay. Dhirendra, in the light of what we have discussed so far, you think that the Indian as far as the Indian stock markets is concerned, it is something which is sustainable in the near future? It will not get affected. Earlier, you expressed confidence that India will not be affected. But in the light of what others have said, what do you have to say?
No, I would still say that we are the only market which actually looks like a promising which can deliver long-term growth, and one has to look at it as a relative destination. When you see China struggling, and when you see an economy which is, despite all odds against it, is still delivering positive growth, is still on a growth path, and the kind of resilience that we have derived, I don't know how sustainable it is, but domestic investors putting money and supporting and been a reasonable counterbalance to FII outflows in the last 1 year. That seems really promising. So I would say that, India's market share of the emerging market, the capital allocation of investors based on the indices is about 8.5%. If we are able to come out of different niche, different positioning for ourselves, and as a standalone market, it could be unusually different. So my sense is that foreign capital will look at attractive destination. India will relatively stack up well. We have our own set of problems, but I think they are far more manageable than, and none of it is of a unmanageable or a very sizable scale.
Okay.
And we have our NPAs. We have our businesses struggling with their NPAs.
No, but your confidence,
cyclicality.
Your optimism and confidence is quite interesting. Mohan, are you,
I think 2 points we have to remember. As far as China is concerned, they've hit a demographic trough. Population stabilized at 1.36 billion, and the old age cohort is growing.
Yes.
China has now got a problem, they say, of aging people rather than new races. So that's really hitting them also. So they're coming to grasp with that reality. As far as we are concerned, one is that the investment is just dropping off. The total savings rate is coming down from 38% in 2008
all this is fine. But what Dhirendra Kumar is saying, the confidence which he expresses that we will still be able to with all these things which has happened, Chinese economy affecting the global economy, but still he's optimistic that we'll be able to.
Our problem is not getting hit and getting into recession. Our problem is not able to get the growth to create 12 million jobs a year. That is our problem, and that will create a different set of problems. You may not have an immediate economic problem, but you will have a political economic problem on it. Large numbers of people joining the workforce. You don't have jobs for them. For that, you need investment. There are a different set of problems.
So this will only add to the. You say that this will only add to the already existing problem.
We are effectively not creating jobs for the last 2 years now.
Right.
You know, we've
Okay.
just not added new jobs onto it.
Okay,
So I can't see any big breakthrough coming for that.
Okay, Mr. Dua, you know, what is it? What are the sectors exactly which is going to be affected by what's happened in China, as far as India is concerned, and also at the global level? I would like Mr. Professor.
2 or 3 sectors clearly come to my mind. One is the steel sector. The second is the tires, automobile related.
Right.
And automobile, as you know, is
And
a very
also all these Indian exports which compete with China. at
textiles,
the global level.
apparel, leather, all those things which I've earlier mentioned.
Yeah.
I think we are going to be hit, one, in terms of a greater intensity of competition in the markets overseas, but we are also going to be hit, and that is where I differ from the gentleman who was talking about the stock exchanges, with 40% of our companies being commodity based.
Right.
And whether it's Tata, Sales, half a dozen companies in the tire world, etc., all of them are going to feel the pinch. And already in their budget proposals, which are under consideration, huge demands have been made yesterday, day before, by chambers of commerce saying, protect our steel industry,
Right.
protect our tire industry,
No,
anti-dumping and others.
So is that one of the solutions as far as India is concerned?
No.
You know, fix high tariffs for Chinese imports.
See, this is where it is. You may do it temporarily, but then you are impacting your competitiveness, because then we are going back to the pre-WTO regimes, etc., where it was saying
the protection.
Protection, and what does protection means? The volumes of production and trade came down.
Right.
I'm not saying that we must go the WTO way, etc., but the idea of free trade regime is to grow in volumes.
Exactly.
And that's not going to be happening.
There's clear case of dumping also.
No, I agree totally.
But we are not prepared to make the case for dumping. Because first of all, we have domestic lobbies which favor import. For instance, a car company, if it can get cheaper steel abroad, will come and lobby for Chinese steel rather than Indian steel.
No, you're
That is
absolutely
one.
right, Mohan.
The other thing is that, we in the Commerce Ministry, we need to have a trade office which is capable of making cases. We don't have enough manpower there.
Okay.
So, by the time we make a case, some years have gone.
Yes,
Yeah.
Professor.
So, we have to
As far as the global impact is
Yeah.
concerned.
So if you look at the global impact, the problem is that China has tried to shift to services sector, but its services sector slowed down even more than the industrial sector. So it's not that they're going to suddenly be able to change track. Now, our strength has been in the services sector. Our exports in the service sector, that have been doing reasonably well. What has happened is petroleum prices have gone down, gold prices have gone down, and that's why our imports have gone down, etc., etc. But our problem will be that as the Chinese yuan falls, our exports will probably also fall further. And therefore, we'll have to worry about that. Globally, the uncertainty will continue, and the financial markets are highly uncertain because they're highly speculative. And if there's a fear that all the currencies will decline, then what will happen is that actually currencies will fall faster than what otherwise would have fallen. Now, if that happens, then capital inflow into the Indian economy will be affected because our interest rates are tending to come down, American interest rates are tending to go up. And therefore, with devaluation, there will be a negative return on Indian investment. And that's why capital will begin to flow out. The stock markets will decline along with the rest of the world's stock markets. So the situation is very unstable. It's very dangerous at a global level. And that's why we need to worry and we need to take advanced action to take care of that.
I think on that note, we need to end. It's quite a challenging situation as far as globally also, and as far as India is concerned. As all my panelists have pointed out, there are quite a few challenges which the government as well as the industry will have to face. We'll wait and watch how this will all pan out in the coming days and weeks. Thanks to all my guests. Please keep watching. We'll come back with another issue in the big picture, same time on Monday. Meanwhile, have a great weekend.